Everybody, hope you've had a wonderful day. Wonderful, and we're going to have a wonderful evening. We always do in here, in my opinion. Thank you for being here. I said it before, you make a difference in my work and what I'm learning, and thank you for that. So we're going to start by doing the 5 steps. Get us all warmed up. Come on in. We'll get started together. And so we'll start by taking some slow breaths. Relax. We have more than enough time, more than enough space, more than enough of everything. Start by claiming your space. Your space can be any size you want it to be, any shape you want it to be, it's yours. Let's clear that space. Gary often describes it as God's hand is sweeping out those things that we no longer need, that are no longer working for us. Belief systems, actions that we choose, demons or dark, heavy forces. People, places, or things from our past or present. Anything that interferes with who we are intended to be, who we really are. If you're relaxed, you know it's clear. See our physical body, our feet are going to the earth. Can you feel your feet? We're grounding ourselves. We're going from the earth to heaven. We're accepting, inviting that energy. That we welcome that energy with forgiveness, with joy, forgiving, acceptance. Nothing can interfere with that energy coming through us with those attitudes. We see our life statement going through us. We invite God, angels, Holy Spirit, Jesus, whomever you want. And they are coming through the joy and gratitude. Joy and gratitude. Thank you, thank you, thank you. Opens up all that power to us. Opens up the channels that we can receive it. Now we see our physical self. If you don't visualize well, feel your physical self being in the circle that we've claimed, that we've cleared. See your physical self observing your energetic self. And when you see it, observe your brain and your heart and your spirit. How much light is in all those places. Are all three spaces in alignment? There's so much light, it floods the room. It floods the area we're in. It floods the city. This light can go everywhere. This light can flood into other people's lives as well as our own. And when those are in alignment, equal amount of light, bright light. For me, this bright light flows through my body. It's just not something I see, I can feel it too. I bring myself, my bright, lighted, energetic self in this circle. And I work first on myself before I invite others. I work on myself. I think and I see and I feel my 2015's prosperity statement running through me. I see those characteristics being refined in me. They're all in me. Now we're just refining them. I'm claiming who I really am. Now I bring others into my circle. These may be people I want to pray for, I want to encourage, I want to support, people that I need to do business with or I need a relationship with. We bring them into the circle. And we flood them with this light. Is anybody sprinkling them with golden light, golden dust? Little kids would say fairy dust. Remember that we're consciously bringing joy and gratitude into everything we do. That's what powers this experience. Trust this process, it really is working. finished. Close with forgiveness and a sense of joy. You can't see the joy, feel the joy. Do whatever it takes to give permission to joy to permeate your being and those around you. And as we close this circle and this experience for now, remember that you can do this anytime, anywhere, any place. And when you're ready, feel your feet, feel your hands. Come back and join us.
Wow, I'm so relaxed I can do this for an hour.
Like a noodle. Noodle.
Okay. So all of you have a handout. So before I go into my options tray, I know some of you asked the question before, and I want to kind of bring it back up again. Okay, it was last year or early this year. Somebody equating like a gambler in a casino and a trader in the stock market. So my question to you is, what separates a gambler in a casino and a trader in the stock market? Now, I have my answers. I'm going to share with you, but I want you to think about that and maybe put down the answers for yourself. Because how you think about, trading will have something to do with your behavior when you get into the stock market or casino for that matter. So take a minute or two, think about what separates a gambler in a casino and a trader in the stock market. Are they the same? Are they different? You all have your own answer, your own opinion. So
What if you haven't been a gambler in a casino, so you really don't know?
oh, okay. So but you know what a gambler is, right?
Well, I know, but I don't gamble, so I
Okay.
don't know the answer to.
Okay.
Do they have rules, or do they stop themselves?
Does it
You know,
say
they have
it
stop
depends on the
losses.
gambler?
It depends on the Are you a compulsive gambler
Right,
or you're an
exactly.
occasional gambler?
Right,
Or
exactly.
you're a recreational gambler, you just take couple $100 and go to the casino and just enjoy yourself.
Some people count cards and they think they're taking a limited
Yeah.
risk and that they're
Right.
taking some
Yeah.
other cards.
Right. Yeah. Okay.
Supposing the trader in the stock market has an exit strategy,
Right.
which the gambler
Right.
in the casino does.
But they may.
They might have a
They
dollar
an
amount,
exit
I would.
strategy too,
Right.
you know? A lot of people just say, I'm gonna bet $100 and that's it.
Right.
And as long as I can play with that $100, then I'm not going to go
But then
any
if
further.
you're doing the trade, especially now that you are equipped with the scanning ability, then then you have the better strategy than the
I know
gambler.
scanning
in
would
the
come in
casino.
very handy in gambling in a casino.
Absolutely.
So all of you believe they are different?
I'm beginning to.
You're beginning to. Okay. So some of you started with the concept of gambling and trading, they are the same. Okay. It could be.
Could be,
It could be.
depending on what kind of gambler you are.
Right. It really depends on the person.
Yes,
Right.
Okay.
Exactly.
Not so much on that action.
I agree.
See, if you are a compulsive gambler, then anything you do could be gambling. I mean, you're staying on a job that you don't like, you're gambling your health away for that salary. Don't you agree?
Yes. Correct.
You're a gambler.
And if
Right.
you're greedy, you're greedy.
Right, right. And exactly. So really, it's not so much on the action, that vehicle you take, but it's really the person. So to me, my answer is, if you have some trading rules, if you have some rules, if you have your exit strategy, then you can enjoy yourself in the casino. If you just say, hey, just like last week I showed you, if you're taking a risk capital of just 1%, you can go and enjoy, go to the casino and enjoy it. And you just, hey, I'm just going to risk 1%. If I win, I'm just going to leave. That's my exit strategy. If I lose, adios, I'm out. Okay? See, casinos, my understanding about casino is they want you to win, but after you win some money, they want you to stay. And most people will stay. And if you stay there long enough, the odds are against you that you will lose more money. Most people, once they win, they want more. They want more. I mean, they're greedy, right? Okay. So if you are a trader, if you are not, you don't have trading rules. You don't have the exit strategy. When you make, so much return in the stock market, you want to gain more, then you stay in. The longer you stay in, the odds are you may not get out. You end up losing more than what you put in. Okay, so to me, my answer is, what separates a gambling casino and a trade in stock markets? Do you have an exit strategy? What are your rules? When you get out, if you have that, you document that, and you follow that, you can enjoy yourself in the casino. Because they say, hey, that's how much I'm going to play. Okay? So that touch on a subject called personal responsibility. I want to touch on that a little bit. Gary, a couple of days ago, asked me to look into a company that I heard about in the radio, so I looked it up. When I look up the company, they offer like free stock seminars in the weekends, 2-hour seminars. And when I researched more, I learned that what they are selling is either a weekly trading program or a monthly trading program, meaning that they will send you the stock tips or option tips on the email, either 3 times a week or 3 times a month, depending on you get into the monthly program or the weekly programs. And what they're selling is that program. But the key thing is, they are a network marketing company. They're a multi-level marketing company. See, what they want you to do is that they want you to go in and subscribe to the program, which is like $99 a month. And if you're able to get 3 of your friends to sign up under you, then your program becomes free. And if you train your 3 friends, they recruit 3 of their friends, then you start earning bonus. Okay? So what they're preaching is that if you don't have knowledge, lack of knowledge, then okay, their stock tips will do the knowledge, for you. And if you don't have the time, they'll send you the email, let you know what to buy, exactly how to trade. So that take care of your time issue. And the third, most people have, I don't have money. That's fine, just get 3 of your friends to join, then your trading program is free. If you help to get 3 of their friends to join, you getting bonus, and use that bonus as your trading capital.
Wow.
So don't worry about, you don't have knowledge, you don't have time, you don't have money. They will take care of all that for you.
Too good to be true.
Too good to be true, right? So that's why I told Gary is that, this is what the program's about. And to me, I care more about, sharing, people about like how you fish instead of giving you the fish. I think the key is, if we have the financial intelligence then no matter what investments that you get involved, then you will know how to like do the research, calculate it whether it makes sense for you. But if you don't have the knowledge, would you agree that buying a house as a rental property can be a risky investment if you don't know what you're doing? Okay, if it's too expensive, you buy it and you rent it and it does cover your mortgage, that turns out that rental property is not a good property to own, right? So it's not so much on the vehicle, it's like you have to take the personal responsibility to get educated. Because once you get educated, then you can become independent. But if you keep relying on somebody to feed you with just fish instead of learning how to fish, then you will forever become dependent on someone else. So that's why, for the case study that I'm going to show you, hopefully I'm showing you how to fish. What I'm thinking when I'm trading those positions, so that hopefully you guys can follow, or you can learn it from from books and what have you. Okay. So any questions? Okay. So I have two case studies for you guys. Trade number 1 and trade number 2. Now, before I go into trade number 1, trade number 2, I just want to say that I did trade number 2 first before trade number 1. Now, trade number 1, I make some return, which I'm going to show you in a minute. Trade number 2, I don't have a return, I have a loss. I want to show you the gain and the loss, and that's just part of trading game. Okay, no matter how you do it, you're going to have losses. The company I was telling you about earlier, they claim that the monthly program or the weekly program earn annual return of about 700% return. 700% return. Now, do you believe that?
No, really?
That's pretty high, right?
Yes.
Now, even Warren Buffett, you all know Warren Buffett, right? His return was annualized to be around 13, 14%. And he's got $50 billion. Second richest person in the world. Right behind Bill Gates. I don't know now if he's ahead of, but those guys are like, depending on the stock price. But even his performance only returned 13, 14% a year. Consistently. He has his losses too. His is not all gain and no losses. So when somebody claimed that they can return like several 100% return a year, you don't want to walk, you want to run. So, be careful when you look into those investment programs. Okay, when they claim several 100% returns, I don't believe it. Okay, if they're that good, they don't need to be selling those programs. They can just invest their own money, right? 700% return, can you imagine? You get 7 times your money every year. Gosh, you'll be a millionaire in no time. You just, right? No way. But people will buy into that. People with the mindset of what? Gambler. I'm hoping that I can bet small amount of money and hoping for a large gain. Okay, that's betting, that's gambling. So learning how to do something like this, legitimate, trading, it takes training, it takes education. Okay?
Yeah.
So having said that, let's go into trade number 1. Okay, so what I did is on trade number 1, step 1 is I run my stock screener to down select a universe of 6,000 stocks to the top 4. Now, you may ask, is this the stock screener we went through last year? No, I use different stock screeners. What I want to do is I just want to down select from a universe of the 6,000 down to 4. Okay, instead of looking at so many, I just want to see if just a handful that I can focus on. So, and you can come up with your own stock screener, or if you have like Fidelity or Charles Schwab, they also have like preset screeners that you can try it and get your top 4, and then you can follow along. And what I did is write a statement to scan, which is the top stock to experience record increase in price over 4 days. Why 4 days? I just want to keep it like roughly about a week or 2 weeks. Then I want to get out. I don't want to stay in for too long because I'm trading, I'm not investing. Okay? Once I have that top stock that I want to look at, I first look at the 1-year chart. When I have the 1-year chart, I draw those channel lines. Okay, channel lines are what, touching 3 points, right? So what I want to do is I just want to get an overall feel for how the stock is moving in a 1-year movement. Just want to get an idea. So next step is I want to look at 3 months chart. Why 3 months? Because I'm doing a short-term trading. I want to get in and out in a week or 2 weeks. So I want to get a feel for the 3 months trend, the shorter trend of this stock. So I draw that channel line for the 3 months. The next thing is I want to look at the volume and the price. And the price volume action is very important. Because when you see a stock going up or going down, don't just look at the stock going up or down, look at the volume. Remember what I said last year, right? When the price is moving up at a low volume, what does that mean? The amateurs are buying. The big boys have not gone in yet. If you go in right there, you may get killed. Okay? But if the stock price is moving higher, the volume is pretty high, then the big monies are moving in. But if the price is going down and the volume is pretty low, who's selling? The amateurs are selling. The big money, they're still holding on the position. Okay? When the price going down, when the volume is high, meaning that the big monies are selling. Pretty simple, right? Pretty simple, right? Look at the volume, look at the volume and the price movement. So what I did is, on this stock, then you can start going into the chart now, at the bottom of page 1. On this stock, BTE is the name of the stock, okay? I bought an at-the-money call option on January 26th. You know what the at-the-money call option is? At-the-money call option is when the stock, let's say the stock is trading at $15.50. I buy a $15 call option. That's called at-the-money. It's right there. That's what the call option, at-the-money call option is. If the stock trading at $15.50, if the option is $17.50, that means it's out of the money, meaning that the stock price has not reached the option price yet. That's out of the money. Okay. So what I did is I bought the at-the-money call option on January 26th with at least 20 days out because I'm buying a February call option. I'm assuming all of you, I want to take a step back. Were most of you here last year when I talked a little bit about options? Mm-hmm. So you know what I'm talking about. You all know what you all know what option is, right? Kinda.
Yeah.
Did all of you don't know what option is? All of you know? Oh, you don't?
That's okay, but I'm following along.
Oh, okay,
pretty
okay.
well.
Okay, simply put, option is the option buyer has the right to exercise the option, but not the obligation.
Okay.
Okay, meaning that as an option buyer, I have the rights to exercise that, but not obligation. What does that mean? Now, once I buy the option, I don't have to buy it. I don't have to buy the stock. I have the right to exercise it. just like when you are shopping for a house, okay? You like the home that you just looked at, and you want to purchase that home. But you don't want to do it right now, because it will take you another 2 months for the loan to process. What do?
Deposit.
Deposit. You want to put down your earnest money. Chances are they want you to put down like $5,000 or something, right? You put down $5,000 earnest money to own the rights to buy that home at some pre-selected, between the buyer and seller, you agree to buy the home at $200,000 in 90 days, whatever. It's got to have the purchase price and got to have the duration, the time period. It's not going to be open-ended, right? That's how when you want to, put a deposit, earnest money, you want to buy a home. I mean, the seller is not going to say, you have for the next 2 years to buy my home at this price. No. The seller wants to sell his home, her home too, right? So it's like, okay, you have 60 days or 90 days for you to process your loan. So that earnest money is like the option in the stock market. You have the option buyer has the right to exercise it, but not the
But
obligation.
if you don't buy that house within the 90 days, you
Right.
lose your earnest money.
Exactly.
And so you don't have to purchase, I don't understand how this works. You
Okay.
buy an option, but you don't have to buy it,
Right. You
but
can sell your option.
before that date.
Right. You can for the stock market, you can sell your option. Now the question somebody asked before was like who's gonna buy your option, right? I mean, in the housing market, when you put down earnest money, you don't buy, then your earnest money is gonna be forfeit.
Right.
Somebody's gonna, the homeowner's gonna take your money. But in the stock market, there's some brokerage called a market maker that they will have to buy your option at the bid and ask price. They have to. That's how they make the stock market moving. Okay, so that's why they have the bid and ask. One is the higher, one is the lower. So when you're selling, you always sell it at the lower price. When you're buying at a higher price. And the stock and the market maker make money by earning those what they call the spread. Okay, so the market maker will have to buy your option when you sell it. So the key is for the option trader, you don't want to hold your option until the end, because when you hold your option until the end, then your option becomes what? Worthless. So you want to take action before the option expires. Okay, that may make sense to you when I'm going through my second example. So going back to to my trade. So on number 6, I bought an at-the-money call option on January 26th with 20 days out and limit risk capital of about $360. Why? Because my option costs about 35 cents a share. Option always trade around lot of 100. When you buy one contract, that's 100 shares. So in this case, that call option is 35 cents a share. And I buy how many? I buy 10 contracts. 10 contract is 1,000. 1,000 times 35 cents is 350. I put in the commission, on that. So $360. So $360 on a $100,000 portfolio is about 0.36%. That's my risk capital. That's how much I'm risking. Okay, you all see that, right? Okay, so why this? I watch the price and volume action over the next 4 days, and you can look back at the chart now. Okay, so you see on the middle of the page, bought 10 contracts of February 20. 1750 call option on January 26 at 35 cents, and 4 days later, that option dropped. On January 30th, that my 35-cent option dropped to what? 17.5 cents. So I just lost what? 50%. okay? Now, I didn't exit because I learned something on trade number 2. Now, remember what I said, I did trade number 2 first before trade number 1. Now it touched my lower channel. Now I don't know if it's gonna go lower, but then what I learned in trade number 2, that I want to stay one more day. I want to stay one more day. I want to see if I'm right. Okay? And trade, and then on next day on so January 31st, okay? Then next day later, you see that, the stock jump up. It takes only 2 days for the stock to what? Hit my upper channel. Now, I believe I wasn't looking at the stock market on that day because I got out on February 4th.
Okay,
Had I been watching the stock market on February 3rd, I would have get out.
okay.
But I wasn't watching. See, I'm not looking at the stock market every day, just, I look at it, but, sometimes when I'm out doing some other errand, I don't look at it. Yes?
So if you follow your own trading rules,
Yes.
then wouldn't you have exited when it drops, let's say, predefined limit 8 to 10%? Would you follow that for options as well?
For my case, no. Why? Because my risk capital was, what, $360. I'm not trading stock now, I'm trading option. To me, I could risk all the $360. But I'm not going to. I will only risk like 75%. But since the price is like very low, I'm willing to accept that risk on trading options. Okay, because it's still within my channel. It touched on it, but it bounced back. You see how that candlestick, that green bar is pretty wide, meaning that the trading is very heavy that day. That's why I didn't sell. I said, wow, there's a lot of trading. The stock is really moving. So I know maybe I'm right, but the timing may take several days to work itself. Okay. So on February 4th, I got out. I sold my call option for $1 for a gain of 185%. I bought it at 35. I sell it at $1. Okay. So questions on that?
So you went from 360 investment to times almost 3 times, so 360 times 3,
Yeah, about $900 some dollars.
$900
Yeah.
you got.
Right.
That's great.
Right. Okay. So that's one example. Okay. So let's go to example number 2. Now, like I said, I did number 2 before I did number 1. When I was preparing, I said, I want to show the good one first. And I said, oh, wait a minute, I should show the bad one first. But since I already prepared, I didn't want to go and change it. Okay. So, trade number 2, same thing. The first 4 steps are the same. Okay, you run your stock screener, you do your scan, you select your top stock, you draw your 1-year channel line, then you draw your 3-month channel line. Then on number 5, notes to myself on the trading day on January 12th. All of those looks like pretty cryptic. But I'll probably just tell a little bit because it would take some explanation to go through that. We don't have time today. But HP is historical volatility. Okay, IB is implied volatility. That just shows you the movement of the option. Meaning that, let's say going back to a home buying example, if historically only about 10% of the house in Dallas moved, past year, only 10% of people buying and selling. So that's the historical volatility. But what happened if all of a sudden, well, we know Toyota is moving the headquarters to Plano, and let's say you get another, Microsoft is moving to Plano. What happened to the housing market? It goes up. So instead of 10% buying and selling, all of a sudden it goes up to 30%. because Microsoft just announced that they're coming to Plano. So what happened to the housing price in Plano or in Richardson or in Dallas? It will be very volatile, right? Meaning that you have to pay more to get into a home in Plano because of the volatility going up. So the IB is the implied, meaning that, oh, I know Microsoft is coming to Plano, so more people are buying the homes in Plano, so it's going to be more volatile. So IB is implied, meaning that implying something happened currently, so it will drive up the volatility of this option. Does that make sense?
Yes, it
Am I clear? Okay. So SPT is support. I know the support level of this stock and the resistance level of the stock. By the way, you can get that from Trade Monster. Okay, it will give you that. Or you can just draw it yourself. You can get that. Market and stock bearish on Monday. That's the Monday that I traded. So that's my comment. And I said good entry point, short-term play. Call delta is 0.54. The delta is just the amount of change in the stock price compared to the option price. 0.54 meaning that when the stock moves by $1, the option will move 50 cents, or 54 cents. So that's the relationship. So the higher delta you are of that option, the more relationship they have. If the delta is 1, meaning that when the stock moves by $1, the option will move by $1 as well. So when you're trading option, you want to have a high delta. You don't want a low delta. Meaning that when the stock moves, you want the option move as much also. Okay, so that's the note to myself. And I said number 6, I traded stock as a pure momentum play as Apple is heavily traded. This is Apple. Okay. Because on January 23rd, the Apple was heavily traded. Well, Apple has been heavily traded. There's a lot of news on Apple. So step 7, buy at the money call option with only 10 days out and a limited risk capital of about $538. Again, that's roughly about 0.5% of a $100,000 portfolio. So that's my risk. I cap my risk. Okay. So I purchased that at $2.63. Okay, that's my Apple call option. I watched price and volume action, and the negative news on oil continued to hurt the market. Because in early January, the oil price was really bad. It was like the oil keep dropping, and it hurts everybody. So it was very bearish. So the notes on myself on January 16. Remember, I bought the option on the January 12. Notes to myself on January 16 was overall bearish market with negative news on oil price. Okay, I already know going in is like the stock market is bearish, but I want to trade. It's a momentum play. I want to just see how it works out. So, and on step 10, I said I saw the stock cross my lower channel. So we look at the chart. Okay, on January 16, it touched on my lower channel. Okay, January 16 on the box on the chart now. I said January 16, Apple crossed my lower channel at a high value with a bearish market. You see that? You see my notes pointing to that point? It touched my lower channel, and the volume is high. So I said, okay, it met one of my rules. I'm getting out. Okay, that's a losing trade. Fine. Losing just part of the game, kind of trading. Okay, so I got out. So when I got out, guess what happened next day? It goes up, right? Do you regret that decision? No, because again, looking at this chart, the hindsight is always 20/20.
Sure.
Remember, you have to put another page right to the right-hand side of January 16th because you don't know what happened on the future days. Now looking back, you know the stock. What if the stock continued to drop? Well, at least I got out. I got out with some money.
Cause that was your stop loss, basically, that was as
Yeah,
far down as you were
yeah,
gonna
right,
go, so.
because it hit my channel.
Yeah.
Meaning that the channel is like my floor, right? Remember the example last year, if there's a sinkhole open up in front of you, if you're dropping into the sinkhole, you want to have a rope tied to your waist. At least you can crawl yourself out.
Exactly.
We don't have a rope. You drop in a sinkhole, you could lose it all. Right?
Yeah.
So always have your safety net or your safety rope. So my safety rope is my channel.
Or same as stop loss.
Yeah, same as stop loss. Yeah, they'll get you out. Okay, so my lessons learned is execute my rules as intended. Had I waited for another day to confirm a downtrend before selling, I could have turned this loss straight into a profitable one. Okay, so that's my lesson. You know, that's why I said, you know, I'm gonna wait one more day. I'm gonna just go wait one more day. So that's what happened to my trade number one. I said, I'm gonna take one more day. I'll give myself one more day a chance. See if it turns. For this case, it turned.
So did you change your stop loss to give yourself one more day then?
One more day.
Okay.
Yeah, give myself one more day. Now, I could be wrong. Another day could be dropped all the way down, but that's what you accept. That's your rules. Remember, that's your rules. Okay? Your rules is trying to help you. So you gotta have rules to help you. Okay, so concluding, why trade option instead of buying stock outright? And my answer is leverage. You want to have leverage. Now, using my example on trade number one, I buy 10 option contracts. It'll cost me, 1,000 times 35 cents. So it'll cost me $350 to control 1,000 shares of the stock, BTE. Trading profit about $17 and what have you. Okay. But if I want to buy 1,000 shares of BTE, I use $16, okay? It will cost me what? $16,000. Yes?
I understand stock, but when it comes to buying options, you usually buy them like 10 days out, 20 days out, but what if, if you hold on to it just a little longer, then it's gonna expire? I mean, what gives you what made you decide to buy a certain stock? I mean, the option?
Well, that's why
10 days out, or 20 days out, or a month out, or, I mean,
I try to give myself as much time, but the longer period, the option is gonna cost more. Okay?
But then what
You
if,
could buy a year out, it's gonna cost a lot. You can buy 2 years out, it will cost a lot.
so 10 days is about,
10 days, I would like 30 days, about a month out. That will allow me to. I also look at the chart pattern too for a short term. Remember, I look at the 3 months, the up and down. So when I'm looking at the stock tend to what? Hit my lower channel, go up to the upper channel, go down to lower channel. I want to measure the time and say, okay, between the lower channel to upper channel, it will take roughly about 10 days. Okay. If the stock behave like it, hopefully behaving like in the past, it will take like 10 days. Okay, so I want to own at least 10 days or 15 days, because it will take that long for the stock to move to my upper channel for me to sell at a profit.
And that's what you do first.